All right, welcome everybody. I'm John Haig. I am the co-director of the Mossavar Rahmani Center for Business and Government. We are extremely fortunate today. We have Jean-Pierre Landau with us, and he is going to talk about monetary policy consequences of COVID-19. I will be very brief, and then I will turn it over to Jean-Pierre, but I wanted you to know a little bit of his background. First of all, I think I'm not sure he would put this at the top of his CV, but we put it at the top of his CV. He is a research fellow in the Mossavar Rahmani Center for Business and Government and has been a senior fellow and research fellow for the past 3 years. He has a very distinguished career in Europe. He's an associate professor right now of economics at Sciences Po and teaches a couple classes. This is teaching a couple classes now. He was a former senior official at the French Treasury and the French Central Bank, and served as the Deputy Governor of the Banque de France, Executive Director for France at the International Monetary Fund, the World Bank, the European Bank for Reconstruction and Development. He was Undersecretary at the Ministry of Finance in Paris, and has had a number of different roles and served in different capacities on the board of the Bank of International Settlements in Basel, the G7, the G20 deputy, and a member of the Financial Stability Board and its steering committee. He's also been a visiting professor at Johns Hopkins. He's co-authored The Euro and the Battle of Ideas with Marcus Brunnermeier and Harold James. It was published by Princeton University Press. He clearly has extensive experience in monetary policy and international economics. And I am going to turn it over to him, and thank you, Jean-Pierre, for joining us. We will try to allow time for questions at the end. Jean-Pierre has some slides he wants to go through, but we'll try to leave probably 20 minutes or so at the end for all of you to ask your questions. It is a webinar, so you can't, I don't think, go into the chat room, but if you put them into the Q&A box, we'll try and track them and make sure we get to them. And with that, Jean-Pierre, it's all yours.
Thank you very much, John. I'm very happy to be back with the center, even if it's on the virtual form, and I'm very grateful for the opportunity to be at the center as a research fellow, and very grateful for the kind introduction that you did. Without further ado, I'm going to share the screen with you. There are a few slides I would like to show, and here they are. So I hope they are visible for everyone. The presentation I'm going to make is certainly neither an academic nor a fully policy presentation. I think we are in a period of deep uncertainty. Nobody knows really how long this thing will last. Nobody knows how much resources will have been devoted to absorbing that kind of shock. And so what's best, I think, is to have sort of try and get us a framework to think about the issues and to see how we can assess the various possibilities for the future rather than. And I'll start with that moment, which I liked very much, was during an April interview of the chief economist of the IMF, Geeta Gopinath. And she was interviewed by Trevor Noah, the well-known TV host in the US. And he came out with this question about the crisis: is there a point where money just runs out? And that was a very interesting moment. She gave him a very robust answer about what all the IMF was doing to mitigate the impact on the crisis, especially on emerging economies. But she did not tell him what she could have told him, which is, we can print as much money as we like. And the fact that she did not say that tells you that she may have thought that that would sort of trigger concerns rather than assuage concerns. The fact that we could print as much money as we like may not have been, in her view, I'm interpreting there, it may not have been the kind of soothing answer that maybe Trevor Noah was looking for. And also it's very interesting because that TV host, of course, is very attentive to public opinion. And as soon as April, people were getting worried, not only specialists, not only economists, not only fiscal experts, but a lot of people were getting worried about the amounts which were spent into facing this crisis. So that's what the kind of question we'll try to answer today. At least not answer, but give a framework for thinking about how much debt we can incur and how much money we can print. Maybe 3 points. A quick look at the current situation. First, a stylized description of what people think and how they react, and we'll see that two opposite attitudes to the current challenges. And then maybe deal with 3 questions on inflation, debt, and the future of central banking. So the current situation and the most likely legacy of the crisis, it's not finished, definitely not. We could describe it in 4 points. First, in all countries, we will have a jump in the ratio of debt to GDP. I would tell today it's be around 20% in all European countries and also in the US. So we'll come out, if everything goes well, we'll come out with a debt to GDP ratio which will have jumped in a matter of 1 year of 20 to 25% of GDP. That's the first point. The second point is that all central banks will come out of this crisis with a very, very large balance sheet. 30 to 100% of GDP for Japan, 30 to 50% for all other advanced economies. This presentation mainly deals with advanced economy, and I have to apologize for people in the audience who may be coming from emerging economies. I'm not cognizant enough, and I haven't looked closely enough to what's happening right now in the emerging world to make wise comments. So I will concentrate on advanced economy. And in advanced economy, the increase in the size of the central bank balance sheet over the last 10 years is absolutely spectacular. 10 years ago, before the great financial crisis of 2009, 2010, the balance sheet of the Fed had the size of a few $10 billion, maybe 20, 30, 40 billion dollars. Now we're talking about 7 to 10 trillions dollars. So 2,000 times bigger. Same for the ECB, same for the Bank of Japan. So we have those central banks who hold assets equivalent, which are very commensurate to the size of GDP. The third, of course, is that as a consequence of all the tools, activism, and unconventional monetary policy that those central banks deployed, a significant part of government debt is held by the central banks and is going to be held by the central bank for the years to come, which would be deemed as a form of monetary financing of the government. And finally, we had, although the central banks are very active, although they keep the market in check, although they try to stabilize the market, we have an incipient instability in financial market. And there was an episode which is widely commented in March 2020, where the US Treasury market, US short-term Treasury market, which is the broader, largest, deepest, and most liquid financial market in the world, had a few days of big disruptions, which forced the Fed to intervene and buy around 300 or 400 billion of assets in a matter of a week or 2 weeks or so. So this is the situation that we will inherit in advanced economy from the crisis. Here you have a few graphs which show just what I said, which are taken from a recent economic report by the BIS, the Bank of International Settlement. 2 further comments about the situation right now. We've been there already. We've been there with huge debt to GDP ratio, and we've been there with huge monetary interventions for the government. But that was in wartime or immediately after wartime. This is no precedent in peacetime. And second, this crisis occurred first after another crisis which took place only 1 decade ago. And second, after a period where both interest rates and inflation were keeping at a very, very low level, this despite all the efforts by the central banks to bring them up with monetary policy hitting what is called the zero lower bound, meaning that interest rates, policy rates were at zero and stuck there, despite the efforts of the central banks to bring them up. So there was already a sense that monetary policy was sort of facing big challenges before the crisis occurred, and that the question, which is a key question we have now, of the relationship between monetary policy and fiscal policy was becoming extremely relevant. When you look at how people, or economists, analysts, observers, market participants, politicians react to that situation, which is again precedented in peacetime, you have, this is an overly stylized presentation, but you have basically two opposite approaches. A significant part of the opinion, whether they are explicit in their concerns or not, and again, Trevor Noah was very representative about that, they fear and they predict that this will not end well, that the conjunction on the very high debt and very high money growth and very large balance sheets of central banks is not going to end well. But I would say on the other side of the spectrum, you have a whole brand of opinion. We say, well, this is exactly the situation we've been advocating and predicating for decades. And this is an opportunity to create a new and necessary monetary regime where financing of the government by the central bank and through money issuance would become a normal situation. And that's, of course, the modern monetary theory. And I will spend a few minutes talking about it because it's well known that it has a huge echo inside a large part of the Democratic Party today. And we are 1 week away from an election which may bring that to the forefront. So first trend of opinion, we would say the current conjunction of debt and money is unsustainable. And I suspect that if you ask market participants, analysts in Great Bank, investment bankers, they would tell you that. And the consensus wisdom in front of a situation would be, well, when there's excess debt, there are only two possible outcomes when we have too much public debt in the economy. The first one is inflation. So the authority inflates the debt away. And that would mean a big change in the current macroeconomic equilibrium and picture. And the second one is default. So the only big governments restructure or do not pay their debt. And the only, if you adopt that very pessimistic but very historically realistic vision of the situation, something like, most eminent economists about that, Ken Rogoff, would certainly adopt as a vision, then the only question is which one of those two undesirable outcomes is the less undesirable? Should we inflate the debt or should we organize default? And those of you who come from emerging economy know exactly what I mean when the question is put on the table as a policy option, right? So if we take that pessimistic view, we see that the only question is how should we organize ourselves in the perspective of either inflation or default? And of course, that pessimistic view also leads people to immediately think on how to cut that experiment that we have now as short as possible, how to think about, and the code word is here, exit. How do we think about exiting the abnormal situation we are in? And how can we project and program for this exit? And at least in Europe, a few people, not that many, but they are influential in a way, are starting to talk about the exit. Now, on the opposite spectrum, you have people who say, well, this is a great opportunity. Actually, we've been advocating that for a long time. And this is a great opportunity to operate a change in the policy regime, which has been governing monetary policy and fiscal policy during the 3 or 4 last decades. And this would sort of develop into two more technical points. The first one is that we have to get a close coordination between monetary and fiscal policy, and close coordination between monetary and fiscal policy is the new normal. So the period of the last 20 years where there was that feeling that monetary policy was independent of fiscal policy and was operated independently of fiscal policy. That period is finished, and it was actually a parenthesis with all the implication for central bank independence. And I remember, John, that we had this discussion in some meeting in Senior Research Fellow, and we had colleagues who are extremely competent and well-informed, who were supporting very much that thesis. And the second one is that we have no inhibition, we should have no inhibition towards monetary financing of public expenditure. And that sort of taboo, which exists, especially in Europe, towards monetary financing of the government, should be dispensed with and dismissed. So let's look at those two issues a little bit more in detail. First, should coordination between fiscal and monetary policy become the new normal? Now, if we look at the instant, if you take a snapshot of the current situation, the answer is yes. Of course, we are in a situation, low inflation, low interest rates, zero interest rates, where fiscal policy has to take the brunt and the biggest part of the task of keeping the economy afloat and relaunching the economy. This is a situation when there are zero interest rates, where fiscal multipliers, as they say, are most effective, and where a fiscal impulse is most effective when it is fully supported by monetary policy. So today, at the moment we speak, there is absolutely no doubt that there is a total convergence of objectives between the fiscal and the monetary side of the government, fiscal and monetary authorities. And this is clearly apparent when both in the US and the European Union, you have the central bankers calling for stronger fiscal action and more immediate fiscal action. Everybody remembers the statements by the Fed chair over the last 3 weeks. So in the immediate future, there's no doubt. But of course, in that school of thought, people say, well, I'm not only talking about a situation where the situation we have now. I think these people think that closer fiscal monetary coordination is a natural situation and should be a natural situation for the future. And for some of them, so you have that very subtle technical economic argument, which I'm not going to develop at length, but if we have questions, we can discuss it. That actually the reason why monetary policy looked as it was dominant and independent over the last 30 years is that fiscal policy were implicitly passive. They were following the lead of monetary policy. They were backing monetary policy in some way. And that backing gave the feeling that monetary policy could be conducted independently of fiscal policy. But that is not, according to that school of thought, that is not the reality. In the reality, fiscal policy and monetary policy have always been intertwined. Here I have an equation. I'm not going to comment on it, but we can come back to it. And that equation shows, a couple of equations shows, formula I should say, show the two situations which can exist, at least in theory, monetary dominance, where the monetary authority sets the monetary stance, in that very, very small stylized formulation, the monetary aggregate, and the fiscal policy has to adjust by changing the surplus over time so that the equation stands. And we have fiscal dominance, where the fiscal policy, the fiscal authority decide on what they do, and the monetary policy adjusts by actually monetizing whenever necessary the fiscal deficit. So fiscal dominance, monetary dominance, two states of the world, and people who argue that closer coordination between fiscal and monetary policy should be the new normal, actually argue that we are going out of 30 years of optical monetary dominance, but maybe fiscal dominance should be part of our future. And implicitly, of course, this theory jettisons central bank independence and accepts at least the risk, if not the reality, of fiscal dominance in the future. And that's why we had so active debate when it was mentioned during our research fellow meeting, because I'm a person who's very attached to central bank independence, so I was not prepared to yield on that ground. But that's, I think, a lot, if not a dominant part of the market analysts and maybe economic profession think along those lines. Even going a little bit further, a step further, looking at the situation right now, looking at very low and stable inflation, actually worrying low inflation, it's getting negative in some part of the euro area right now. It's close to zero almost everywhere in the advanced world. And we are creating an enormous amount of money and there's no inflation. So a lot of people who've been advocating for sort of active monetary financing of the government are feeling vindicated today in that situation. And they argue that monetary financing should be part, and sometimes the essential part, of the financing of governments. And this position has, I would say, 3 dimensions. First one is a technical dimension, and just to mention it quickly, but again, we can discuss that later. When you have zero interest rate, money and short-term government bonds are basically the same instruments. They are, as we say, close substitute. So why should we focus on one source of finance rather than the other, when actually they are both the same? So that's the technical dimension. There is an economic dimension, this idea that once you have exhausted all conventional and unconventional tools to support the economy and try to push inflation a little bit up, there is the so-called helicopter money situation, where the central bank basically distributes cash or something which is close to cash directly to households and corporates. And it has been argued with a lot of elaboration and sometimes veracity that it may be an appropriate tool to fight deflation if deflation were to materialize, or to avoid the risk of deflation if it were to become too high. And in the last year, I think the former chair of the Fed, Ben Bernanke, has come out with a column which examines the pros and cons of helicopter money and does not dismiss the whole idea altogether, while pointing at its technical difficulties and drawbacks. And then you have a whole political economy dimension, through the emergence, and not emergence because they've been there for 20 years, but through the revitalization of the modern monetary theory, which, as I said, has been espoused by a significant part of the most, I would say, leftist part of the Democratic Party, and may play a big influence in elaborating the economic policy if and when the Democrat candidate becomes president of the United States. So what does the modern monetary theory say? It says that those 2 bullet points on these slides are absolutely true and unchallengeable. The bullet points of the next slides are a matter of discussion. So the 2 things which are absolutely true and unchallengeable is that a sovereign state can issue money in unlimited ways, in unlimited quantities, and that it can impose the use of money in transaction by asking that taxes be paid in that money and that public debt should be paid back in that money. So that is absolutely true. This is a sort of synthetic exposition of what is called the state theory of money. The government, the sovereign, can make sure that it issues money and that money is used. And second, more technically, when you look at the detailed operations of the Treasury, and this is not always well explained by the supporters of the modern monetary theory, but it's true, every time the government spends $1, they create $1 of money. Every time they borrow or tax $1, they destroy $1 of money. This is technically true. So those two close links between the government and money are economically and technically true. From that on, the supporters of modern monetary theory tells us, well, there's no problem then. Why don't we finance routinely the government for issuance of money? And that's where, and they say first, the focus on the deficit, the question of the deficit of the budget is wrong. And you know that one of the major supporters of that theory, who is Stephanie Kelton, has just published a book which seems to be a bestseller, which is called The Deficit Myth. Money can be regulated by raising or tax that, and therefore you don't have to worry about the deficit. You just cover the deficit by imprinting money. What are the assumptions which must be true and may not be true for this theory to hold? First, implicitly, they said that money and debt are equivalent and substitute, and today it's true, but it's not always true. And they are very close in that to one other theory, which is fiscal theory of price level, which I will not describe, but we can discuss it. In my view, the main weakness is on the second bullet point, right? There is an implicit assumption on money demand and the fact that people are willing to hold money in unlimited quantity. Because if the government issues money to finance its expenditure, that means people have to hold that money, right? And I used to say, and I think it's a very important distinction, the government can force you to use money in transaction. They cannot force you to hold money, at least in a liberal, democratic, non-financially repressed society. And so my big question for the modern monetary theory, what if people don't want to hold the money that the government is issuing in large quantities? And we know what's going to happen in that. It's going to happen that people will try to exchange money versus goods, and there will be inflation. So that risk of inflation due to a change in the demand of money is, in my view, severely underestimated by the modern monetary theory, which has a theory of inflation which is much more sort of Keynesian one. There is no inflation as long as we are very far away from full employment. So mixed diagnostic. It's certainly a theory which is attractive today because we have huge unemployment and no inflation. So maybe today, if I had to defend the modern theory of money, I would say, yes, well, today we don't, any inhibitions toward monetary financing, whatever the legal framework, whatever the political framework, may not be technically justified. But we have to think about the future. We have creating a lot of money. What if in the future people don't want to hold that money again? And this is an issue that I will come back to. Actually, my point here, and maybe this is the only slide where I would send a personal message. My point here is that both approaches are making actually the same mistake, but in a symmetric way. They both pretend to come with a vision which is consistent for today and for the future. So the alarmists would say the future is dim, therefore we should be very careful today. And the modern monetary said, today we can issue money, so there's no problem for the future. Both approaches are wrong. And my deep conviction, and I think that I'm pretty sure a lot of policymakers share it, even if they are not explicit about it, is that what is needed today and what is needed tomorrow are actually two very opposite things. We need to be as permissive as possible today because the situation calls for it. But we need to be very careful tomorrow not to destroy the foundation of what has done our macroeconomic stability. And this kind of schizophrenia between what we must do today and what we must care for tomorrow is the most difficult thing to manage. And I must confess, I don't have a full-fledged vision or solution on how it should be done. But I am convinced that this is the way to go forward. And those people who are too alarmist, and if they express this alarmism too strong, they will create concern that will impede the efficiency of the response today. And those people who are too optimistic and think we can do anything we like today, they will risk destabilizing the policy frameworks, which we will need in the future to operate in a more normal macroeconomic situation. So I would say we should use all the policy space today. And the policy space today is enormous because we don't have inflation. So we can do almost everything. But we should use it in a way which does not destroy the whole system and does not create instability for the future. That's very difficult, easier said than done, but we will see how it can be approached through 3 questions. I have only 7 minutes left. Is that correct? Yeah. So I'll go very fast. Inflation, nobody knows. Nobody knows what is going to become. We don't really understand why it was so low over the last decade. We are reasonably sure it's not a problem in the next 18 to 24 months, unless something very, very dramatic happens in the world in terms of strategic tensions or something like that. So no inflationary problem for the next, I would say, 24 months. And actually, as you know, in most countries, it's not expected that we'll get back to the GDP level of 2019 before the middle of 2022, 2023. So any kind of output gap may not be resolved before 2023. No reason why inflation should start. We cannot exclude a dramatic event, but I don't mention it there. Money demand is very strong. People are willing to hold money, they are willing to hold debt, they are willing to hold safe assets. But what about the future? Should we aim at higher inflation? Here I would make a distinction. In a way, central banks are aiming at higher inflation. They want to raise inflation higher than it is now. And part of the review, recent review of the Fed is to say, well, we adopt average inflation targeting, which means that we can go a little bit higher than 2% for a few years. The official motive, of course, is to get monetary policy more stimulative, to get real interest rate more negative. Accessorily, of course, 5 or 6 years of inflation at 3% might help wipe out part of the debt which has been accumulated. So it's not a bad idea. The question, of course, is that there's a difference between high inflation and accelerating inflation. And accelerating inflation is something nobody wants because, of course, you don't know when it starts to accelerate, when it will stop. And again, and then you get to levels which might prove very, very disruptive for the economy. So again, a very difficult balancing out between getting higher inflation and preventing accelerating inflation, especially if people start expecting that the fiscal authorities will push the central banks to be more permissive than they should do. Second point, debt sustainability. The debate has been marked by a major contribution by Olivier Blanchard, who is the former chief economist of the IMF, former professor at MIT, who published a great paper a year and a half ago. And that paper is based on a simple idea. We are in a period where the interest rate is lower than the growth rate in real terms. So intuitively, when the interest rate is lower than the growth rate, the debt to GDP ratio diminishes. The debt grows slower than the GDP, and so the debt diminishes. So this is a situation where debt sustainability is not by itself a problem. And we can live with a higher debt to GDP ratio because it will stabilize or even reduce as long as the interest rate is lower than the growth rate. That is true. That is, of course, absolutely true with 3 caveats. First, some countries have a primary deficit, which is a deficit which you run before you're paying interest rates. So after you pay interest rates, you have even a bigger secondary deficit. And that, of course, changed the whole dynamic. This is the case of many European countries, including mine. And so if you have to add, including to the charge of interest, if you have to include a primary deficit, the whole stability of the system might not be the same. Second, the reasoning of Blanchard is true for quote unquote safe countries. But as many emerging and even European countries know, not everybody is safe. Not everybody is safe. And a lot of countries have to pay a risk premium in the form of called a spread on the market. And that spread may bring the interest rates well above the growth rate and make their debt unsustainable. And third, the debt markets can be have their own dynamic. And even if rationally the debt should be deemed as sustainable, there may be liquidity squeezes, there may be liquidity events, there may be what economists call multiple equilibria, as the one which occurred. There may be liquidity incidents as the one which occurred in March for the Treasury. And that, of course, every time that occurs, that pushes interest rates up. And so that instability is there. It may create cycle of, I've represented one here, I'm not going to elaborate on it, but it may be that a perfectly solvent government has difficulty to roll over or to finance and to borrow. One of the main tasks of major central banks in the world is to prevent that. And it has been recognized for almost centuries that central banks have a duty to stabilize governance debt market and avoid a seizure and liquidity squeezes on those debt market. But that still can be occur. So it's, even if the interest rate is lower than growth rate, it's not going to be for most of governments on the planet an easy time in the future. This is what I said. And my conclusion on that, and I would advocate that, including for my own government, I'm amazed that we don't do it more. This is the moment to issue long-term debt. All governments should issue massively long-term debt. You can issue long-term debt for very, very low, even zero interest rate, in some cases negative interest rate at 10 years, 15 years. If you have a long-term debt, you don't have to refinance it. You are less dependent on the whims of the markets. You are less dependent of the possible illiquidity events on the debt market. So if I have one sure, I'm not sure of that. I don't have many certainties in the current circumstances, but I'm pretty sure that issuing long-term debt is a very, very good move for most of the government. One quick word of central bank independence. You clearly see that both intellectually, politically, financially, the central banks are finding themselves in a much more challenging situation than they were 10 years ago. I think independence is the key to the balance that I mentioned between being very agile and very permissive in the long run, in the short run, and keeping the framework robust in the long run. But it's going to be difficult when you hold a large part of government debt. The condition for pressuring the central banks to keep supporting the government debt market is going to be very, very strong, very, very strong. They will have risk in their balance sheet. They are piling up risk in their balance sheet, and those risks are quasi-fiscal risk. And they take great care of mentioning that they are not fiscal agents, that even if they take risk for the sake of monetary policy, it's not their purpose to take risk. And you have that wonderful sentence by Chairman Powell, like a month or 2 months ago, which he keeps repeating with good reason. We are lending, not spending. We conduct a monetary policy, we don't conduct a fiscal policy, but still. And last but not least, there is either an obligation or a willingness by central banks to diversify their task and their mission, which sometimes is called dismissively mission creep. So of course, they are very active now in credit markets. So there may be a temptation to try and allocate credit, which is not their job. Their job is to stabilize the economy. They don't have a role for allocating resources. They don't have a mandate for that. And of course, in the current circumstance, where concerns about the climate change are extremely high and everybody is looking for ways to act more decisively on climate change, some central banks, including the European Central Bank, are considering whether they should be more active into that and contribute to the Green Deal and the green finance. That would put them, with very good motives, that would put them into, again, something which is different from their traditional stabilization role. And some people, I'm amongst them actually, think their legitimacy could be put at risk and their independence could be put in danger. But that's an open debate. That's a very open debate. And that's one of the fascinating questions that we have to face now. Independence vis-à-vis the fiscal authority, independence vis-à-vis what maybe legitimate aspiration of the society, and keeping their framework robust to make sure that they can absorb possible shocks in the future, which would allow them to be very agile in the present. John, I think I almost kept to the time limit that you mentioned. I've been very fast and sometimes very vague, but I'd be very happy to answer questions.
We will open it up to questions. You can put them into the Q&A box and we will try and track them. And I will take the liberty of, as monitoring, asking a few questions myself to start things off. So one of our colleagues, Larry Summers, has written extensively about something called structural stagnation.
Yeah.
And structural stagnation was basically a belief that the real interest rate, R star, they call it the neutral interest rate, has declined significantly. And there are a lot of reasons people can debate and discuss why that's the case, but partially a reduction in aggregate demand, and so that it's very hard to stimulate the economy. That occurred kind of prior to COVID. And so I guess as I start to think, and I don't claim to be a macroeconomist, you're much more knowledgeable than I am, so I'm happy to listen and learn. But it seems to me that there's a question about whether he's right and what the impact is of COVID on that belief, because one of your concerns is that, you know, your options was to inflate basically out of the debt situation in the future. But if you're really suffering from structural stagnation, how can you inflate the economy if you wanted, even if you wanted to? And it seems to me that central banks have been having some difficulty even getting inflation up prior to COVID. So I'm just trying to square that circle a bit, and I don't know if you can help me think about that.
So first point, I think this intuition, at the beginning, intuition, the theory developed by Larry Summers is absolutely illuminating. And for me, it's been a revelation of what we are going through. And I would encourage everybody to watch his sort of improvisation in November 2013 and a seminar in the IMF with no notes, no paper, nothing. And for 15 minutes, he starts developing the hypothesis. It's absolutely fascinating. I think he's right. I think he's right. So basically, if R star, if the real rate, if real equilibrium interest rate is low, there's nothing that monetary policy can do about it, because the only thing that monetary policy can try and do is not having its own policy rate above R star, because if you have it, this is the whole weak self thing, then you contribute to further depression. But to bring R star up, you have to de-save and you have to invest. And because R star is basically the equilibrium between saving and investment. And if the private sector is not ready to invest or is ready to save too much, which is the case for many reasons, then the public sector has to do it. And this is a very strong case for public infrastructure spending. And you remember that one of the sentences he came up with, everybody talks about Kennedy Airport, which is the worst airport in the world. But when we say we should repair it, they say, no, it's not the moment. Well, if it's not the moment, now.
Now is the moment.
Right? Now is the moment, right. And then he has a development on the bridge on the Charles River, which I think everybody should read. It's really nice. So in that perspective, the way you finance, I'm not sure he's taken a stance on how this program expenditure should be financed, whether it's money or borrowing, I think, but it's a second order of magnitude as compared to the main concern that we don't have enough spending or investment in the economy. And of course, now we have a very big negative demand shock on the economy. So in a way, that sort of strengthens even the necessity for spending. And so let's say we have a democratic president next year. One thing I'm sure is that there will be, I'm reasonably sure that there will be an increase in spending, and especially in funding infrastructure. How that will be financed, how that will be decided to be financed is another question. But the first order of importance is, of course, yes, stimulate aggregate spending and stimulate investment. I think from that point, I'm very much inspired by what Larry Summers said.
So I'm going to continue asking questions unless somebody puts something into the chat box or the Q&A box. So I struggle with this question of how much independence central banks should have. On the one hand, I kind of completely understand that you want to remove them to some extent from political pressures and enable them to focus on what they need to focus on and the stability of the economic system. On the other hand, some coordination with fiscal policy seems to me to lead to more rational outcomes potentially. And I'll give you a specific example. It's a simple one. One of my students a few years ago wrote a paper on this, which turned out to be very influential. But the example was, it's a relatively simple example, and he calculated out the cost, if you will. So the Federal Reserve in the United States decides that it wants to stimulate the economy, and so it takes up monetary policy actions to try to lower the interest rate and stimulate the economy. The Treasury, the US Treasury, on the other hand, looks and says, fantastic, the interest rate is lower, we should borrow more. And so they go in and they kind of suck up some of the capacity that the Federal Reserve has created, and the impact of the Federal Reserve's policy is diminished, but the United States government has borrowed money at favorable interest rates. Is there an opportunity to kind of coordinate in a way that's productive and manages that tension? And I'm conflicted because, you know, central banks are highly independent institutions in a democratic context. And so do you have thoughts on how to kind of think about that kind of problem?
So I have, I think, an economic sort of comment of what you made, and then maybe a personal comment, which is personal. On what you said, of course, I think any central banker would accept that independence is not isolation. And the example that you mentioned, where basically the debt management policy annihilates or contradicts what the monetary policy is doing, is one example of this, right? So you have two independent authorities, the fiscal one and the monetary one. They manage basically the same balance sheet. So it's a very strange situation where you have two authorities managing the same balance sheet. And the example that you mentioned is exactly that. So they don't have to be isolated. I think the Fed chairman, many times they mentioned that they were having regular weekly breakfast with the Secretary of the Treasury. They didn't think it would impede their independence. So independence is not isolation. And if two independent authorities are not acting with a minimum of exchanges and trying to share what objectives they are pursuing and what kind of intervention are visible, yeah, and of course, it's a very bad situation. And the situation you described is a typical example of that.
Right.
My second point, yes, I think the one thing which could really derail let me give you a bad scenario for the economy. I don't think I'm not, but let me give you a bad scenario, right? I mean, you have a huge amount of money in the hands now of the private sector. And that they're willing to keep that money, but as I said, the demand for money may be unstable and nobody can force you to hold money. So let's say and I mean, one of the drivers of the demand for money is inflation expectation. So let's say that inflation expectations start to raise for some reason. That's a scenario which unlikely, but not zero probability. And the velocity of money starts to increase. Then you start to have some kind of push for inflation up movement. Then we should think that the central bank should react if we are above its target, right? If we already have reached the 2-3%, and that happens, right? But of course, if it's perceived 2 years before that it will not react because of the fiscal problems it could cause the government, then those expectations will grow much faster. There are a lot. I mean, this is the unpleasant monetary arithmetic of certain products. So if we want people to have a stable money demand today, we must make sure that they don't expect that the central bank will yield tomorrow, which is a very difficult trick, right?
Right.
If they don't expect that the central bank will yield tomorrow, then the central bank can do whatever it likes today. That's exactly what I'm saying, you know?
Yeah.
And I think and now a last remark, I think central banks fully independent in the narrow field of their mandate. These are not elected officials. These are unelected officials. So they should not be entrusted, in my view, but that's a personal view, they should not be entrusted to decide implicitly or explicitly which kind of corporates will be financed and which kind of corporates will not be financed, which kind of bonds will be deemed, quote unquote, green enough so that they can buy it, and which kind will not be deemed, quote unquote, green enough so that they don't buy it. This is not their job. This is allocation of resources, and allocation of resources should be done by the government. So if the government wants them to do this, they should give them an explicit mandate. So it's very important. They should be fully independent in the narrow objective of their mandate, which is to get to price stability and maximum employment in the US.
So we have some questions that have come in, and I'm going to just start at the top and we'll work through them. First one, when you suggest we issue long-term debt, in the case of the US, what is the potential market for 30 or 50-year bonds? As you know, the maturity schedule of treasuries is very front-loaded. Can the market, primary purchasers of treasuries, support tens of hundreds of billions or more of 30-plus year debt?
Okay. So the comment I made was partly irresponsible, and I was aware I was making that because I discussed that with my colleagues from the debt management agency in Paris, and they tell me exactly the same kind of things that you just mentioned. So the reason why governments do not issue longer term debt is because their debt management agency tell them it's going to be difficult and costly. And this is the kind of reasoning that you mentioned. And that's true. That's true. And I think it's a job of a debt management agency to tell the government, if you do that, it's going to cost you 50, 25 basis points. My point there is that we should have a thinking as citizens of whether we should, I mean, you were mentioning derivative in the private conversation to protect us from the future.
Right.
Whether paying today 50 basis points more to protect us from further financial accident down the road may be good. Right. So I acknowledge it's more a concern for European governments than the US government for various reasons. But that is something that should be considered, and we should protect people who will live in 10, 15 years, will be active then from, we should think whether it's not a good way to protect them from financial instability, even if we have to pay a little more.
All right, the next question. There is an argument that the question, at least in the immediate future, is not debt sustainability in an environment with zero interest rates, but whether you can finance the debt, i.e. pay the interest rates, which is zero currently, and if you are a large developed country, you can indefinitely roll over the debt, that the debt will never really need to be paid. I'm not sure I fully understand. You probably understand it better than I do, but
yeah. So of course you can roll over the debt, but what is a debt crisis, right?
At what rate?
I mean, an acute debt crisis is a situation where you cannot roll over the debt at all. And that happens. I think people in emerging economies know about. But a significantly serious debt crisis is where you can roll it over, but at a very higher interest rate.
Right.
Okay.
Right.
And that is the link with the previous question. Today, you can borrow zero. So why don't you use that possibility to protect you from the fact that maybe in 5 years you will borrow at a more expensive rate? So if you borrow 5 years today, you pocket a very small interest rate. So of course you pay zero interest rate. yourself to the rollover risk, which is described by your second questions in 5 years. If you borrow 15 years, you pay a little bit more expensive today, significantly not actually, because the markets are what they are, and they are supported by the central bank. But you don't have the rollover risk in 5 years, and you eliminate the risk that you have to pay higher interest rate in 5 years. So the two questions actually complement each other very well.
They do. They do. Okay, this is the last question in the box, and we're approaching close to time. What are the highest likelihood events that could spur inflation higher, even if they are low likelihood in relative terms? What keeps you up at night in terms of potential inflation expectations?
I think if we have to think of a scenario which would trigger inflation concern in the next 2-3 years, it has to come from the supply side of the economy. It cannot come from the demand side of the economy, because the demand side of the economy is going to be very, very disinflationary. So what could make a supply shock possible in the next 2-3 years? Well, a big geopolitical event, which would disrupt oil supplies in many parts of the economy. That's a possibility. A totally disruption for similar reason of supply chain. So we could have shortages of some goods we are considering as essential in our life. And the COVID itself is both a demand shock, but it's primarily a supply shock, right? We cannot produce anymore. And a lot of people 3-4 months ago would have expected that inflation would have grown, would have been higher, would have increased more quickly because of that supply shock. So I would say my generic answer would be, if we have inflation in the next 2-3 years, it will come from the supply side, either for physical disruption or strategic disruption. Now, what's interesting is what happened after that. And the standard, I would say, operational book in a central bank will tell you, if you have a supply shock, you just look at the expectation. If the expectation don't move, you don't act. But if they move, you act, right? So the big question is what the expectation would do in that case. And if expectations start to grow up, then with a huge amount of money balances around the world, I think central banks should start acting. But that's a big series of ifs. A significant negative supply shock and expectation with this encore expectation.
So terrific. So we've managed to end pretty close to the time. It is a little after 5. I just want to say thank you so much to Jean-Pierre. As usual, I always learn a lot in our conversations and appreciate it. Eric, thank you so much for taking the time to do this. And I'd like to thank all of our listeners and participants, and I hope you have a good evening. Enjoy the situation, even though at least in Boston and Cambridge, it's kind of overcast and raining and cold, but hopefully you're all going to enjoy your evening. So thank you very much, and we'll talk again soon. Jean-Pierre, thank you.
Thank you for the opportunity, John. Thank you. Bye-bye.